right? So if you look at broad money supply, like checking accounts, savings accounts, currency in circulation, if that goes up a lot, then by definition you have monetary inflation. But then the question from there is, then what goes up in price? Does anything go up in price? Do some things go up in price, not others? So normally when we have a monetary inflation, something somewhere is going up in price, and it depends when, like what exactly it is. If you have periods of commodity shortage and other sort of things like that, then you're likely to get broad consumer price inflation. So your gas prices go up, copper prices go up, and then all of that trickles into all the finished goods you do. All that things go up. On the other hand, if for whatever reason technology or outsourcing or periods of commodity oversupply are able to keep those prices down, then instead we tend to see that inflation show up in asset prices. And so you see, stock indices like, price to earnings ratios get really elevated. You have real estate become very expensive as a multiple of, say, average wages. And you start to see basically those financial assets, they're the things that are kind of scarce relative to the amount of money in the system. And so they get propped up in prices. And more recently, we've been seeing that second type of inflation where a lot of money has been poured into, stock market, real estate market. Bonds have gone, over the several years as their yields have gone down. That means their prices have gone up. We've also seen, things like gold or Bitcoin do very well. And so really, we've had a lot of asset price inflation. And then certain types of markets have also seen consumer price inflation, but it's been less than certain other decades. And so one of the things to watch as we move forward a couple months is that we are starting to see some basically consumer price inflation. So we've seen commodity spikes, right? So we've seen lumber go up to record prices. We've seen copper got pretty expensive there. We started to see basically a reflation in various commodity prices. The next thing to look out for is that a lot of these inflation numbers are compared year over year because we tend to think in year over year terms. And last year, during the March, April, May, June period, that was actually when we had a dip in prices for things because that's when the whole economy shut down. And so when you're comparing this upcoming spring to those period from a year ago, you're likely to get pretty heated numbers because you're basically comparing to very easy comps, you could say. Like, so for example, and that's going to apply to a lot of economic data. And so let's say you're a corporation, and let's say you have a blowout quarter. You did amazing in a certain quarter, and then 12 months later, you did good again, but you're comparing to yourself how much did you grow from that other amazing quarter. It might not be super high because you might have done so well that other period. You're like, I mean, it was a tough comp to beat, so we only we went up 3%. On the other hand, if you have an absolutely terrible quarter and then you fix the things or the economy improves and then 12 months later you have a great quarter or even just a decent quarter, when you're comparing it to that horrible quarter, the numbers could be great. Like you're like, oh, we're up 50% because last time we were on fire and now we're not on fire, even though we did it, we didn't do great, but at least we're not on fire now. And so you have those easy comparisons. And so a lot of economic data, we're going to have kind of headline shocks. Journalists are going to love this because you can have all sorts. You can paint it however you want. You can be like, the economy's booming because it's up, X percent because you're comparing it to that hole that we fell into when the pandemic hit, when the lockdowns all were kind of at their harshest. And so that's something to watch out for, is that when you see some of these headline numbers, maybe take a step back, and look at the month over month numbers or look at the 2-year averages. And that gives you probably a better sense of what's happening than, that specific 12-month period that'll be kind of distorted.
Sounds good. Sounds good. Now you can correct me in regards to, and we won't continue down the rabbit hole of inflation and deflation. When it comes to, let me share my screen really quickly. Share screen. Make sure it's the good one and not the bad one. Can you see that right there?
Yes.
All right. So over and over, I keep hearing this, and how it has been taught to me, and what I have learned is the Fed actually creates. I call them Chuck E. Cheese tokens, but they call them what do they call them? Reserves. We're going to go with they create reserves. And so then they take those said reserves, which there was nothing back in 2008. Where was it forever? Nothing. 06, 07, 08. And then all of a sudden they started creating reserves in the banking system. And people say, no. This is actually money. And I say, no. these are reserves. Now let me keep going down. Let me stop share. Oh, and then there was one other thing, is the velocity is like in the pooper. There's nothing there. It's not moving around. If there was really money in the system moving around, we would probably see money in the system moving around. So here we go. Fed creates said Chuck E. Cheese token, like that. I have a Chuck E. Cheese token. And then the the Treasury creates a bond. Who wants to buy the bonds? The banks say, I will, because they are handpicked. Thank you, handpicked banks. They buy that said bond. What are they going to do with the bond? Well, the Fed will actually take that said bond with Chuck E. Cheese token and put it on their balance sheet so the banks can lend from that. Please tell me if I got close.
Yeah, that's pretty much right. And there's a couple, there's a couple nuances, right? Because one thing to keep in mind is that a lot of people, no matter what the situation is, we have a tendency to fight the last battle. So say we lost a sports game, we focus on, whatever mistake we did, that's we're focusing on worrying about happening again. Same thing when we have a recession, people always assume that the next recession is going to look like the past recession. And so what happened in the past recession, the 2008, 2009 crisis, and then the aftermath, was that we had, like as you pointed out, central bank assets were a very small percentage of GDP prior to then, and banks were highly leveraged. And so what happened was, when the private sector debt bubble blew up, so real estate values went down, all these banks were highly leveraged. They had, very little cash reserves. So they pretty much went insolvent. And so the Federal Reserve and the Treasury came in and said, okay, we're going to buy some of these toxic assets from you. We're also going to buy some of the treasuries from you. Basically, we're going to create new base money, or Chuck E. Cheese tokens, as you point out. We gave them to the banks and then took some of their assets in return. So the Fed, they took something in return for those assets. Some of those things were worth money, like treasuries and mortgage-backed securities. Other things ended up being toxic and then kind of basically filtered through and kind of removed from the private sector. And so, however, that didn't get out into the broad money supply. That mainly just stayed in the banking system to recapitalize the banks and to help them be more solvent, essentially. And so, if you looked at broad money supply, it didn't really do much at all from that that 2008 to 2015 period where they were increasing those bank reserves for that first leg up. It's because if you were a homeowner and you lost your job and you couldn't pay your mortgage, you lost your house. You didn't get bailed out. There were minor fiscal programs like cash for clunkers or things like that. There were, around the margins, there were these fiscal stabilizers, but there wasn't some sort of big kind of public bailout. It was mainly to shore up the financial system. And so some people got bailed out. Most people didn't. Most people on Main Street didn't. And so we didn't have that big increase in broad money supply. So bank reserves are things that, the banks, they hold it with the Fed. And so it's an asset for the bank, but it's a liability for the Fed. Then the banks, when we have money, like when you or I have money, we store, if we store it at the bank, that's the bank's liability and our asset. And so that's the part of broad money. And so what made this 2020 to 2021 period somewhat different then is that broad money supply actually did go up quite a bit. And that's because, unlike the 2008, 2009, all the way up through the years after period, this time they actually did send a lot of money to people. So they sent people stimulus checks. If you lost a job and you weren't getting your income, they would send you $400 a week in extra federal unemployment benefits on top of the state benefits. And so for some people, got literally thousands and thousands and thousands of dollars of stimulus. Then you had, the PPP loans that mostly turned into grants. So basically small business loans that were then forgiven in large part. Then you had corporate, grants, essentially. I mean, they weren't loaned for the most part. They were given. And so what that did was that actually increased the broad money supply, because the way that the mechanism there works is the Treasury sent people money out. They're like, you get a car, everybody gets a car. Then they issue bonds to pay for that. But then instead of the private sector buying those bonds and that draining cash from the system, the Federal Reserve creates new base money and buys those bonds. And so the way that it gets into the broad money supply and out of the Chuck E. Cheese area is that fiscal component where they literally send you the check. And so that's kind of how the 2020/2021 period has been somewhat different than that other period, and why broad money supply has gone up very quickly. Now, there are still some issues, like for most of the past year, people had limiters on how much they could spend that money, right? So people were mostly skipping their vacations. They were, they're driving less. And they were, mostly staying at home and basically being far more efficient with how they, did things. And they invested in like a second Netflix subscription, or they bought Disney Plus or something, rather than go on like a trip to Europe, or traveling around. And so that the things they spend money on, were not the more inflationary sort. So energy prices were low, all sorts of things were low. The concern to look out for now is that people's bank accounts are largely stuffed with cash, and things are opening up, and we're heading into the summer, and we have these easy base effects. So now we're in the period where some of that inflation might actually start to